If you can come up with $500 a month, you are closer to becoming a millionaire than you think. Not because of luck, not because of some secret stock, but because of math that most people completely ignore. I am Charlie Invest, and I break down money and wealth using real numbers and disciplined strategy. If you want serious, no-hype financial education that actually makes sense, subscribe to the channel and press like, so this message reaches more people who are ready to build real wealth. Wealth creation is rarely about brilliance. It is almost never about a single breakthrough investment. In my experience, it is about something far less exciting and far more powerful: consistency combined with time. The idea that $500 a month can eventually grow into $1 million sounds unrealistic at first, especially in a world obsessed with rapid success stories and overnight market winners. But the truth is uncomfortable for many people. You do not need an extraordinary income to build serious wealth. You need a repeatable process and the patience to let mathematics do the heavy lifting. $500 per month is not a trivial amount, but it is attainable for many middle-income earners with disciplined budgeting. It represents a structured decision. Instead of upgrading a car every few years or increasing lifestyle costs with every raise, that $500 becomes a fixed investment into productive assets. The transformation does not come from a dramatic stock pick. It comes from the interaction between steady contributions, average long-term market returns, and decades of compounding. The surprising part is not the contribution size. The surprising part is how exponential growth behaves over time. To understand this, the math must be stripped down to its essentials. There are only three variables that matter in this equation: how much you invest, the average annual return you earn, and how long you remain invested. Assume a $500 monthly contribution. Assume a long-term average return between 8 and 10% annually, which aligns with historical broad market performance over extended periods. Now extend that timeline to 30 or 40 years. When those three inputs are combined, the outcome becomes powerful. At 10% annualized returns, $500 invested every month for approximately 35 to 40 years crosses the $1 million threshold. The total amount you personally contributed over 40 years would be $240,000. The remaining $760,000 is growth. That difference is the result of compounding. It is not your labor alone that creates the million. It is the time your capital spends growing. The longer the money remains invested, the less important your raw contributions become relative to growth. This is where most people miscalculate. They assume wealth is built primarily through how much they put in. In reality, time does most of the work. Remove time, and the equation collapses. Add time, and even modest contributions can snowball into life-changing sums. Consider two individuals. One begins investing at age 25. The other waits until age 35. Both invest $500 per month. Both earn the same 10% average return. The first investor continues until age 65, giving the money 40 years to compound. The second invests for only 30 years. The difference in outcomes is not incremental. It is dramatic. The 25-year-old investor can accumulate well over $1 million, sometimes significantly more depending on exact returns. The 35-year-old investor, despite contributing the same $500 monthly, ends up with hundreds of thousands less. The reason is simple. The earliest years carry disproportionate weight because each dollar invested has the longest runway for growth. When you delay 10 years, you do not just lose 10 years of contributions. You lose 10 years of compounded growth on every early dollar. This is what I refer to as compounding on compounding. In the early years, growth appears modest. You may invest $6,000 in a year and see only a few $100s in gains. It feels slow. It feels insignificant. But eventually, something changes. The accumulated balance becomes large enough that annual growth begins to rival your yearly contributions. Later still, the growth exceeds what you put in. At that stage, your money is working harder than you are. If your portfolio reaches $500,000 and earns 10% in a strong year, that is $50,000 in growth. That growth alone is more than 8 years of $500 monthly contributions. This is the tipping point, and it only exists because of the decades that came before it. Understanding this shift changes how long-term investing feels. Instead of asking, "How can I get rich quickly?" the more productive question becomes, "How do I stay invested long enough for compounding to take control?" The focus moves from performance chasing to endurance. Skepticism is natural at this point. People immediately ask about market crashes. They point to recessions, financial crises, and sharp downturns. The concern is valid. Markets do not rise in straight lines. There are periods where portfolios decline 20, 30, even 50%, but long-term average returns already include those events. The 8 to 10% historical average is not a smooth upward climb. It is a result of volatility, corrections, and recoveries over many decades. In fact, regular monthly investing benefits from downturns through dollar-cost averaging. When markets fall, your fixed $500 contribution purchases more shares. When markets recover, those additional shares compound. Volatility, over long periods, becomes less of a threat and more of a structural feature of growth. The key is remaining consistent during those declines, when emotions are strongest and discipline is weakest. The mathematics behind $500 becoming $1 million is straightforward. There's nothing complex about the formula. What is complex is human behavior. People abandon plans during downturns. They pause contributions during uncertainty. They wait for better timing that rarely arrives. The challenge is not intellectual. It is emotional. Knowing the math is only the beginning. Understanding a consistency, time, and average returns can mathematically create significant wealth does not guarantee the outcome. The real question is whether someone can maintain the discipline required to let those decades unfold without interruption. And that is where execution begins to matter more than calculation. Execution begins with structure. Discipline is not a personality trait reserved for a small percentage of people. It is usually the result of systems. If the goal is to invest $500 every month for decades, then the most reliable method is automation. When contributions are automated directly from a paycheck or checking account into a diversified investment account, the decision is removed from the equation. There is no monthly debate. There's no emotional negotiation. The money moves before it can be spent. Over a multi-decade timeline, systems consistently outperform motivation. Motivation rises and falls with market headlines, economic cycles, and personal circumstances. Systems do not. An automatic transfer into a retirement account or brokerage account ensures that investments continue whether markets are rising or falling. This matters because consistency during downturns is where compounding is quietly strengthened. When investors rely on willpower alone, they tend to contribute enthusiastically in bull markets and hesitate in bear markets. Automation neutralizes that behavioral weakness. Once consistency is in place, the next decision is where that money goes. The assumption behind the $500 path to $1 million is not that an investor will outperform the market. It is based on capturing average market returns over long periods. Historically, broad market index funds have delivered approximately 8 to 10% annualized returns when measured over multiple decades. These returns are not guaranteed, and they fluctuate year to year, but they represent the aggregated growth of thousands of companies operating within the global economy. Asset allocation is the structural backbone of that return. Instead of betting on individual stocks, diversification spreads capital across sectors such as technology, healthcare, manufacturing, energy, consumer goods, and financial services. It also extends geographically, allowing exposure to both domestic and international markets. This reduces the risk that any single company or sector failure can permanently damage a portfolio. The goal is not to eliminate volatility. The goal is to eliminate catastrophic concentration risk. This strategy assumes sustainability. It does not depend on identifying the next breakout stock. It does not require predicting interest rate movements or quarterly earnings surprises. It relies on the long-term productive capacity of businesses collectively growing over time. When you own the market through diversified funds, you participate in innovation, expansion, and economic growth without needing to forecast which individual company will lead the next cycle. The contrast between disciplined investing and emotional market timing becomes clear when examining two hypothetical investors. Investor A attempts to time the market. During periods of volatility, this investor moves in and out of equities, trying to avoid downturns and re-enter before rallies. Investor B remains fully invested, contributing $500 every month regardless of headlines. Historical data consistently shows that missing even a small number of the market's best days dramatically reduces long-term returns. Those best days often occur close to the worst days during periods of high volatility. An investor who exits during downturns frequently misses the recovery. Over 30 or 40 years, missing 10 or 20 of the strongest market days can reduce total portfolio value by hundreds of thousands of dollars. The cost of emotional reaction compounds negatively, just as disciplined investing compounds positively. The investor who stays fully invested does not avoid downturns. That investor experiences every decline, but they also capture every recovery. Over decades, remaining invested has historically outperformed attempts to sidestep volatility. The difference in final wealth is not driven by intelligence. It is driven by endurance. While $500 per month is sufficient under certain return assumptions, the path becomes even stronger when contributions grow over time. Most careers involve incremental salary increases. If contributions increase by 3 to 5% annually, aligned with income growth, the impact on long-term wealth is significant. For example, increasing contributions modestly each year can shorten a timeline to $1 million by several years without requiring drastic lifestyle changes. This adjustment does not rely on large jumps. Even an additional $20 or $30 per month added consistently can meaningfully accelerate compounding. Over decades, small increases compound into large differences. Instead of remaining fixed at $500, the investor allows contributions to scale gradually, preserving purchasing power and increasing total invested capital. Tax efficiency further strengthens the equation. Investments held in tax-advantaged retirement accounts benefit from either tax deferral or tax-free growth, depending on the account type. When taxes on dividends and capital gains are deferred, more money remains invested and compounding each year. Over long horizons, this difference becomes substantial. For example, if annual taxes reduce effective returns by 1 or 2 percentage points, the long-term impact can be hundreds of thousands of dollars. Minimizing tax drag is not about avoiding taxes unlawfully. It is about structuring investments within available legal frameworks so that capital compounds as efficiently as possible. Retirement accounts exist specifically to encourage long-term investing, and their structural advantages enhance the compounding process without increasing monthly contributions. When consistency, diversification, contribution growth, and tax efficiency are combined, the pathway to $1 million becomes structurally sound. It is not fragile. It does not depend on perfect timing. It does not require exceptional stock selection, but it does require emotional control. The temptation to deviate during extreme market movements remains the primary threat. At this stage, the framework is clear: $500 per month invested consistently into diversified assets, allowed to compound over decades, with incremental contribution increases and tax efficiency, creates a mathematically credible path to significant wealth. However, there are practical realities that influence outcomes. Inflation affects purchasing power. Risk changes as portfolios grow. Life circumstances interrupt plans. Understanding how to manage those realities without derailing the long-term objective becomes the final piece of the equation. The framework is structurally sound, but it must be grounded in realistic expectations. When discussing 8 to 10% average annual returns, it is important to distinguish between nominal returns and real returns. Nominal returns represent growth before inflation. Real returns account for the erosion of purchasing power over time. If inflation averages 2 to 3% annually, then an 8% nominal return may translate to 5 or 6% in real terms. This distinction matters because $1 million 30 or 40 years from now will not buy what $1 million buys today. The strategy still works, but the target must be viewed in inflation-adjusted terms. In practical terms, reaching $1 million in future nominal value may equate to a lower present-day purchasing power. That does not invalidate the plan. It reinforces the importance of starting early and allowing contributions to grow over time, so that inflation is outpaced rather than feared. Realistic expectations also shape asset allocation decisions as life progresses. In the early decades of investing, volatility is not only tolerable but beneficial. A younger investor with 30 or 40 years ahead benefits from market downturns because regular contributions purchase assets at discounted prices. A portfolio heavily weighted toward equities during this stage maximizes long-term growth potential. However, risk tolerance is not static. As retirement approaches and the portfolio grows substantially, the consequences of major market declines increase. This introduces sequence of returns risk. If a severe downturn occurs just before or during the early years of withdrawals, the portfolio can be permanently impaired because funds are being withdrawn while asset values are depressed. Protecting accumulated capital becomes more important than maximizing growth at that stage. Gradually shifting a portion of the portfolio toward more conservative investments, such as high-quality bonds or diversified income-producing assets, can reduce volatility and cushion against large declines. This does not eliminate risk, but it moderates it. The goal transitions from aggressive accumulation to preservation and sustainable withdrawal. The compounding engine that was built over decades must now be managed carefully to support long-term financial stability. To see how this unfolds over a lifetime, consider a disciplined investor who begins at age 25. This individual commits to investing $500 per month into diversified index funds. Contributions are automated. Each year, as income increases modestly, contributions rise by 3%. During market downturns, the investor does not exit. Contributions continue uninterrupted. The portfolio experiences recessions, bear markets, and recoveries. At age 35, the balance may appear respectable, but not extraordinary. At 45, growth begins to accelerate. By 55, annual portfolio gains in strong years may exceed annual contributions by a wide margin. The investor periodically rebalances to maintain a consistent allocation, ensuring that risk does not drift too high after extended bull markets. As retirement approaches, the allocation gradually becomes more conservative, reducing exposure to severe drawdowns. At no point did this investor need extraordinary income. There was no reliance on selecting individual stocks. There were no dramatic shifts based on economic forecasts. The strategy was methodical. Over 4 decades, the combination of consistent investing, compounding, modest contribution increases, and disciplined risk management systematically built substantial wealth. Life, however, does not unfold in perfect straight lines. Job losses occur, medical emergencies arise, income fluctuates. These realities must be acknowledged. Before aggressive investing begins, building an emergency fund covering several months of living expenses creates a buffer. This reduces the likelihood that investments will need to be liquidated during downturns to cover short-term needs. Temporary pauses in contributions may happen. The strategy is not invalidated by short interruptions. What matters is resuming consistency as soon as stability returns. The long-term habit must be preserved even if the monthly amount fluctuates temporarily. Flexibility and resilience strengthen the plan more than rigid perfection. The deeper transformation required is psychological. Most people measure progress in months. They check balances frequently. They react to quarterly returns. Long-term wealth building requires shifting the time horizon from months to decades. Instead of asking whether the portfolio grew this year, the more relevant question becomes whether contributions remained consistent. Ownership of productive assets is the core principle. When you own shares of diversified companies, you own claims on real economic output. Businesses innovate, generate profits, and expand over time. Market volatility reflects changing expectations, but underlying productivity tends to grow across long horizons. Focusing on that ownership perspective reduces the emotional weight of short-term fluctuations. The surprising math behind $500 per month is powerful because it rewards patience rather than intensity. It does not demand extreme sacrifice or exceptional talent. It demands endurance. The compounding curve is slow in the beginning and steep at the end. Most people quit during the flat portion because it feels insignificant. Those who persist reach the phase where growth accelerates dramatically. The key takeaways are straightforward. $500 per month invested consistently in diversified assets can grow to $1 million given sufficient time and reasonable long-term returns. Starting early dramatically reduces the effort required because time amplifies every dollar invested. Behavior matters more than prediction. Attempting to outguess the market introduces risk that often undermines compounding. Tax efficiency and incremental contribution increases strengthen outcomes without requiring drastic lifestyle changes. Most importantly, long-term discipline transforms an ordinary saver into a millionaire, not through financial genius, but through mathematical inevitability. The formula is simple. The challenge is staying committed long enough for the formula to work. If you stayed until the end, you now understand that building wealth is not about chasing trends or getting lucky. It is about consistency, patience, and letting compounding do its job over decades. If this breakdown gave you clarity, press like so. This message reaches more people who need practical financial education. Subscribe for more serious, data-driven content on investing, money psychology, and long-term wealth building. And if you have questions or want a deeper breakdown on any part of this strategy, leave a comment below.